Hello, welcome to Tax Advisory. I'm Hwee Theng, Corporate Tax Partner of RSM Singapore. Today, I'll be sharing on the key tax considerations relating to capital gains. It is important to note of the implications so that you can plan ahead to mitigate risk and achieve efficiency. Traditionally, Singapore does not impose capital gains tax. This means that profits from the sale of long-term assets are generally not taxable, except those falling under Section 10L, which I will elaborate later. Even though so, the distinction between capital and revenue gains may not be clear at times. The badges of trade is usually applied to determine this. For instance, some of the badges of trade that we often consider are: first, the motive for acquisition, where we ascertain what was the intent when the asset was first acquired. Next, we also look at frequency of transactions, where we examine if there are similar buy-sell activities done regularly. Thirdly, the length of period of ownership, as in how long an asset is held, may shed light on the intent. And another critical factor to consider is also the circumstances responsible for the sale. These badges of trade are applied collectively to conclude the intent. Take for example, a property was acquired 10 years ago to house the business operations. The initial motive was to hold it for long term, and there is no history of buying and selling properties frequently. 10 years later, it was sold due to the company's financial constraints. Considering the factors under badges of trade, it may have good grounds to substantiate that the property is held for long term, but this is still subject to the IRAS agreement. Many a times, the circumstances may not be so straightforward and can be grey and contentious. So it is important for companies to maintain proper documentations, such as directors' resolution, etc., to substantiate the basis in anticipation of IRAS query. A new Section 10L comes into effect from 1st January 2024, which reshapes the capital gains tax landscape as it overrides this traditional approach. Section 10L may apply if your group companies are not all incorporated or registered in Singapore, coupled with your Singapore entities lacking adequate economic substance or in the disposal of foreign intellectual property right. For instance, if your Singapore company is caught in the above, when it sells its foreign property and brings the gain into Singapore, the gain may be subject to tax. So if you require certainty, whether under the traditional rules or Section 10L, you may also consider applying for an advance ruling with IRAS ahead of the transaction. As you would appreciate, ascertaining what is capital or revenue may not be straightforward at times. So it is important to understand the tax implications early and plan ahead. If you have concerns in this area, feel free to reach out to us at RSM. We'll be happy to explore further with you. Thank you for watching. Don't forget to like, share, and subscribe for more insights. Do stay tuned for more of our bite-sized tax updates from RSM. See you!